How's it going today, guys? So what I wanted to talk about today in this video are the trading indicators that I use whenever I'm looking at a stock. So my trading strategy for the most part is technical stock analysis, and this involves, looking at the charts and looking at how the stock is technically performing as opposed to fundamental analysis, which is where somebody will buy a stock based on company fundamentals or company strength. So when you're making a fundamental trade, you would spend your time looking at financial reports, profit loss summaries, things like that would tell you how the company is performing as a whole. And generally speaking, when you're doing fundamental stock analysis, that's for a position trade, which is where you're going to be holding that stock for a long duration of time. Personally, what I've done the most work in and the most studying is in technical stock analysis, which is where you're looking more at charts and patterns. And you're going to do a swing trade, which is generally about a 2 to 5 day hold, and you're going to be making smaller profits that add up over time. Now you can use like a combination of both. You can swing trade part of the position where, let's say, you buy a stock based on a swing trade or based on technical stock analysis. You sell part of your position and then you hold the rest of it as a core trade or as a position trade where you're holding that for the duration. So you can do a blended strategy, or you can buy based on technical analysis and hold the stock for duration. It really comes down to whatever risk you're comfortable with. But these indicators are ones that I use in technical stock analysis, and I wanted to just kind of explain them to you. Now I'm not going to go through and explain to you what exactly you're looking for when you're using these indicators, and I'll explain why. First of all, that would be making this video probably over an hour long because there's a lot to each one of these indicators. And the second reason is because I actually just finished an ebook I'm working on for the last 3 months, which goes through each and every one of these indicators and explains to you what it is you should be looking at. So for example, if you're looking at candlestick charts, or if you're looking at a stock to volume, it tells you what are the buy signals and what are the sell signals of that indicator. So if you're interested in that ebook, I will link up to it in the description, and there should be something on the video as well where you can click on the corner and it'll tell you more about that. But because I've already gone into a lot of detail in that ebook, I'm not going to go into so much detail in this video because I kind of just want to provide an overview to you guys, and then if you want to learn more about them, you can either find out more of my ebook or by doing your own research online. But the first indicator I want to talk about is charts. Now there's 3 types of charts people generally use: line charts, bar charts, and candlestick charts. So I'm sure you've seen a line chart. If you go on Google or Yahoo Finance and you search a stock, you'll get a line chart, which is a stock's closing price over a designated period of time. It's just one line, and it shows you where the stock is closing and where the stock performed during that day. Most people, as far as stock trading goes, when you're a complete beginner, that's the only chart people look at, and it's crazy to me because there's so much more to trading a stock than looking at a line chart. So then we get into bar charts, and a bar chart is a vertical bar representing a stock's price range for that day. So it shows you the high that the stock traded for that day as well as the low. And then we get into candlestick charts, and candlestick charts, there is so much to know about them. People have written entire books and courses on candlestick charts. I know a little bit about them, and I know some of the symbols and patterns with candlestick charts, but I don't know enough that I want to teach you guys about it because some people have done such a good job already teaching about candlestick charts. I don't think I would even do it justice by talking about it, but I want to point you towards that because that's what I look at when I'm doing technical stock analysis. I use a website, stockcharts.com, and it lets you put on any of these other indicators on top of the chart so you can analyze a stock. But it will show you the candlestick chart. So what a candlestick chart shows you is it's basically a combination of a line chart and a bar chart in a way, because it shows you basically where the stock opened that day, the range at which it traded. So that's called the shadow, which is how high the stock went and how low the stock went that day, as well as where it closed. And then the color of the actual body itself, it's called the real body, is either going to be red or black, and black means that there was a profit for the day, and red means that there was a loss for the day. So it's amazing how much information you can get looking at a candlestick chart. It gives you a whole snapshot of what that stock did during that day. So I guess that would be like the number one thing. If you were going to look at one of these indicators, I would say learn candlestick charts, because that's the best way to really get a good snapshot of what that stock is doing. So then we get into volume. Volume is basically how many shares change hands each day. And this is something I want to explain to you as well, because volume is like probably my number 2 on the list as far as what indicators you guys should be using. That's because volume is a great second confirmation or a second opinion. And here's why. Every single one of these other indicators here, simple moving averages, relative strength index, unbalanced volume, and many of the other indicators are derivative of price, which means they're basically analyzing the price of that stock or whatever the stock is doing price-wise and giving you an indicator in that direction. Volume has nothing to do with price, so volume operates independently of price. So when you look at a stock's volume, it's like, here's how I would explain it. It would be like if you got a haircut and then you looked in the mirror at yourself and said, okay, I don't know if I like this haircut, and then you called up your friend and said, hey, can you ask them if they like this haircut? It's like getting a completely second or separate opinion on something instead of just looking at it from one perspective, being price. So when you include volume in there, it has nothing to do with price in certain ways. So I hope I explained that well. It seems like that might be a little bit confusing to you, but it's just a completely separate opinion of that stock is how I would say it. Next on this list here is SMA, which is a simple moving average. That is a stock's average price over a designated period of time. I follow 4 simple moving averages when I look at a stock: 20-day, 40-day, 50-day, and the 200-day simple moving average. I guess I'll go into a little bit about this. I don't want to go crazy with it because, like I said, I already covered all this in my ebook, and there's a lot of other great sources about this online. But when you're looking at simple moving averages, you want to see your 20-day, 40-day, 50-day, and 200-day all in order. So what that means is your 20-day simple moving average should be on top, followed by your 40, then your 50, and your 200-day moving average should be all the way at the bottom. The only thing I would say is if you're in a very bearish market, it's possible for stocks to be trading under the simple moving average or even under the 200-day simple moving average. So it depends on market conditions. But for the most part, when you're looking at a stock, you want to see all those in order. So you want this lowest one, the 20 on top, and the 200 at the bottom. The 200-day simple moving average is also sometimes referred to as the power line because it is a very strong area of support or resistance for a stock. Support and resistance meaning if a stock is falling and approaching the power line, it may land at the power line and stay at that level as a support for the stock. In contrast, if the stock falls below the power line or the 200-day simple moving average and it's in an uptrend, it may have a hard time breaking through the 200-day simple moving average. So that's pretty much the basic overview of simple moving averages. I talk about it a lot more in my ebook if you want to know about what signs you should be looking for with simple moving averages, and they're one of my favorite indicators because they give you a really good idea of the support and resistance areas for a stock. Next is the RSI, which is either called the relative strength index or relative strength indicator. It means the same thing. What it is, it's an oscillator that measures a stock's current relative strength index compared to price history. And what an oscillator is, it's a momentum indicator that tells if a stock is overbought or oversold. All right, so an overbought stock means that people have bought into it too much. There's too much bullish pressure in that stock, and it's due to correction. It means it's trading at the upper end of its price range. On the other hand, an oversold stock means that it's too many people have sold the stock, and it's scraping the bottom of its price range. So anytime a stock falls into an overbought or oversold condition, it is generally due for correction. So if it goes into an oversold condition, it may mean that it's due to bounce higher, and if it's overbought, it may mean that it's due to fall because people have invested too heavily into it. That's also a really good indicator. I really like those because it can be a good way to tell whether the stock is increasing due to just hype and people dogpiling into the stock, or if it has a healthy uptrend that's able to grow over time without going into the overbought condition. Okay, so next on this list here is gaps. A gap is something you'll see when you're looking at a stock chart. That's an open space in a trading window, and this is because there was an absence of trading at that window. A gap can happen when a stock opens. This is due to people buying the stock off trading hours and basically lining up to buy the stock when the market opens, and as such the stock will jump, meaning there's no trading between where it closed at the end of the day and then where it opens the next day, that is a gap there, which means nobody bought or sold the stock at that price. It gaps up to a new price level based on either bearish pressure or bullish pressure, because a stock can gap up or it can gap down. Gaps are something that are important to look at because they usually always get filled. So if a stock gaps up somewhere down the line, it will probably gap down, because they're kind of, I don't really know how to explain that well, other than just know that a gap up may look like a great sign for a stock, but eventually it will likely gap in the opposite direction. So it may not always be such a good sign for a stock. So you kind of have to use other indicators and see how it is performing as far as, the relative strength index, volume on the stock. You need to use a blended strategy of what other indicators you are comfortable with to determine what is really happening with the stock. I wouldn't suggest using just one of these because that doesn't provide you a good snapshot. You want confirmation with multiple indicators with a stock. Okay, the last one that I wanted to talk about is on balance volume. This is basically a line chart that shows whether money is flowing into or out of a stock, and it's based on if the stock closed higher or lower for that day. So if the stock closes higher that day, that volume for the day counts as up volume for the stock. And if the stock closes lower than the previous day's close, it counts as down volume for the stock. So that's a good way to see whether people are pouring money into the stock or if the money is kind of falling out of the stock. It's a good way to see what's going on with it. What I want to say before I mention these two here is you want to use a blended strategy, is what I said. You don't want to use just one of these, but at the same time, you don't want to use so many indicators that you fall into information overload, because at that point, you're going to be in analysis paralysis, which is where you're looking at so many different things. They're going to start to contradict each other, and you're going to end up being paralyzed and doing nothing. So what I suggest you do is get comfortable with a couple of them. And there's a lot more. If you go on stockcharts.com and you go on the bottom and you click the drop down, there's dozens of indicators that you can learn about and become familiar with. And everybody understands things differently. So find indicators that you're comfortable with and ones that make sense to you. Yet you don't want to use just one of these. You want to use a blended strategy of many. And at the same time, you don't want to use so many indicators that you're just have no idea what to do because they're contradicting each other and you're just doing too much analysis. If you're looking to learn about more indicators, these are two I'm learning about myself currently. I didn't want to get into them in this video because I don't feel that I know enough about them to speak about them. But MACD is called Moving Average Convergence Divergence. That's a really good indicator. I've been kind of toying with it and learning more about it, so eventually I might include some information about that in a video. And then stochastics. Stochastic gets a little bit confusing even for me. I mean, I've done a lot of studying on these indicators, so I know a little bit more than most people do as far as technical stock analysis goes. But stochastics really don't make sense to my brain, so I don't really mess around with those. But if you're looking for other indicators, I would look at those two as well. And then just kind of look at these and see which ones make most sense to you and familiarize yourself with using them. So that's pretty much all I got for this video on trading indicators. Like I said, if you want to know more about the buy and sell signals based on these indicators, I do have the ebook that have been working on for the last couple of months. And with that ebook, I basically have been studying the stock market for quite some time now. I've read many books, talked to many different people, and read a lot of guides on it. And I basically pulled all the best information from those resources and compiled it into this stock market trading guide that's mostly based on technical stock analysis, because that's the kind of trading that I do most of the time. And personally, I've had pretty good luck with trading. I have consistently made, a couple $100 most weeks trading stocks. And the idea with, swing trading or with any kind of short-term trading is that you're going to have some losses and you're going to have some wins, but your wins outnumber your losses. And I've had success with that. So, I mean, some weeks I may not make as much, other weeks you make a little more, but I've consistently had a couple $100 every week just from, an hour or two a week of stock analysis and trading. So it's something that I really recommend people at least learn a little bit more about to see if it's something they would be interested in. But thank you guys for watching this video.